All right, let's just dive right into this. Welcome to today's Explainer, where we're going to unpack the architecture of really the ultimate financial deception. We are talking about a scheme from over a century ago that's so infamous and honestly so perfectly engineered to exploit human psychology that its basic blueprint is still impacting how we invest today. And, well, how we get scammed today. We're going all the way back to the 1920s to look at the absolute foundation of financial fraud. 50%. I just want you to let that number sink in for a second. Now imagine someone looking you dead in the eye and offering you a guaranteed 50% return on your investment. No wild stock market swings, no super risky startup ventures to worry about, just pure guaranteed profit. And the kicker? They promise you're going to get that 50% return in just 45 days. So the real question is, would you invest? I mean, it sounds completely impossible, right? Every modern instinct we have absolutely screams that this is a trap. But here's the fascinating part. Over 100 years ago, thousands of incredibly intelligent, hardworking people looked at that exact same promise and said, yeah, count me in. They handed over millions of dollars to one single guy, setting off a chain reaction that would literally echo through history. All right, Section 1, the immigrant dream. Let's talk about the man behind the whole operation, Charles Ponzi. Now, like millions of immigrants of his era, Ponzi had a dream, but he wasn't really interested in the slow, steady, multi-generational path to financial stability. No, he had this burning, almost obsessive ambition for rapid wealth. He didn't just want to be comfortable, he wanted to be rich, and he wanted it right now. He was born in Italy in 1882 and arrived in the U.S. in 1903 with practically nothing to his name. He bounced around working all these odd jobs. He was a waiter, a dishwasher, a laborer, but then, bam! We hit 1920, and his name just explodes into the financial stratosphere. He's a celebrity overnight. Yet the whole thing comes crashing down, and he ends up dying completely penniless in Brazil in 1949. The guy who promised the world infinite wealth ended up with absolutely zero. So, how exactly did he get from washing dishes to running a multi-million-dollar empire in 1920? Moving on to Section 2, the postal coupon illusion. To get people to actually hand over their life savings, Ponzi needed a hook. He needed a supposedly brilliant business model that sounded just sophisticated enough to be true, but simple enough that he could pitch it to the average person on the street. And he found his golden ticket in this thing called the International Reply Coupon, or IRC. Now, an IRC was just a simple voucher used to prepay international mail postage. That's it. But the real genius of Ponzi's pitch relied on this little quirk in the global financial system back then: the varying exchange rates between countries. Ponzi realized that, technically, a coupon bought in one country could be exchanged for postage stamps of a higher value in another country because of these fluctuating rates. So he pitched what is essentially a classic arbitrage model. Here's the brilliant three-step business plan he sold to the public. Step 1, his agents would buy these coupons dirt cheap overseas in countries with weaker currencies. Step 2, they'd ship them over to America and exchange them for U.S. stamps. And step 3, they liquidate those stamps and just rake in enormous profits. On paper, to an everyday person, it sounded totally flawless. It was like the secret glitch in the global mail system that only the brilliant Charles Ponzi had figured out. But practically, in reality, doing this at the massive scale he was claiming was a total logistical impossibility. But investors didn't realize the logistics were impossible, mainly because Ponzi completely blinded them with secondary promises that were somehow even more insane. If 50% in 45 days wasn't enough to tempt you, how about 100% profit in just 90 days? He was telling people he could literally double their money in 3 months. The hype was just intoxicating. And we aren't just talking about gullible folks here. We're talking doctors, teachers, business owners. People were actually going to banks, taking out loans, just so they could hand that cash right over to Charles Ponzi. Success just fueled more success. The more people who jumped in, the more legitimate the whole thing looked. Which brings us to Section 3, the secret behind the scam. All right, let's pull back the curtain and look at the really dark secret here. Because behind the closed doors of his busy office, a very different reality was playing out. On one side, you have his claim, this incredibly complex web of international postal arbitrage making massive, totally legitimate profits. But on the other side, their reality was simply this: new money pays old. That's the whole secret. There were no giant boatloads of postal coupons. There was hardly any real business happening at all. He was simply taking the cash from the guy who walked in the door today and using it to pay the returns to the guy who walked in 45 days ago. And when those early investors got paid out, well, what do you think they did? They told their friends, they told their family, and this absolute tidal wave of new money rushed in to keep the whole illusion afloat. And let me tell you, that tidal wave was massive. By 1920, Ponzi was pulling in hundreds of thousands of dollars each and every single day. In the 1920s! I mean, that is an absolutely staggering amount of daily cash flow. Newspapers were calling him a financial genius. He was living the ultimate celebrity lifestyle. We're talking expensive tailored suits, luxury cars, a huge mansion. He was the undisputed king of the financial world. But the whole thing was funded by a total mirage. Section 4. The empire collapses. But as you know, math is incredibly unforgiving. You can really only rob Peter to pay Paul for so long before you just run out of Peters. The impossible math finally caught up with him, and his empire started to collapse. And the unraveling happened fast, through a devastating succession of red flags. First, journalists finally started asking the hard questions. Financial experts sat down, crunched the numbers, and realized his claims were mathematically impossible. One newspaper actually pointed out that to pay his investors, Ponzi would have needed millions and millions of postal coupons, and there literally weren't even that many in global circulation. Then, the banks started getting suspicious. Authorities launched their official investigations, and the second the public caught wind of all this, pure panic. Everyone rushed to pull their money out at exactly the same time, which instantly drained the system of its only real asset, the new cash.
And just like that, the music stopped. In August 1920, the entire scheme completely unraveled. Ponzi got arrested and was eventually convicted of fraud. But the real tragedy here wasn't Ponzi going to prison. It was the thousands of everyday investors. The teachers, the doctors, the factory workers, people who lost their entire life savings. The wealth they were promised just vanished into thin air, leaving absolute financial ruin behind.
And finally, Section 5. Timeless lessons for today. Now, this is a wild piece of history, sure, but we aren't just talking about the 1920s for entertainment. Let's pivot to the enduring legacy of this disaster, because while the year has definitely changed, human nature absolutely has not. We can pull 4 critical, timeless lessons from Ponzi's downfall. First up, the big warning sign: high returns with practically zero risk. The lesson? Always be deeply skeptical. In the real world, return is intimately tied to risk. Second warning sign: a confusing business model. The lesson here is dead simple. If you can't explain exactly how an investment actually generates its profit, just don't invest in it. Third, hype and popularity. The lesson is to verify before trusting. Just because thousands of people are jumping in doesn't make it legitimate. Thousands of investors can be completely wrong. And finally, emotional appeals. Scammers always rely on emotion, while successful investors rely on cold, hard facts. Never let greed blind you to the glaring red flags. And this matters right now, today, because Ponzi schemes definitely didn't die with Charles Ponzi. They just got a really slick digital upgrade. Just look at the modern equivalents we deal with all the time. Fake investment funds, insanely complex cryptocurrency scams, multi-level investment frauds, unregulated online trading platforms, and those relentless get-rich-quick schemes flooding our social media. The technology might have evolved from paper postal coupons to the blockchain, but the core psychology hasn't changed one bit. Whenever you see returns that depend mostly on bringing in new investors, instead of actually creating real economic value, you are looking straight at Charles Ponzi's ghost. So that brings us to the ultimate takeaway. It's a phrase you've probably heard 100 times, but maybe never with quite this much historical weight behind it. If an investment sounds too good to be true, it probably is. Real wealth isn't built on secret loopholes or guaranteed shortcuts. It's built through patience, productive business, disciplined investing, and making highly informed decisions. So as we wrap up this explainer, I want to leave you with a bit of a provocative thought. Armed with the knowledge of exactly how the original fraud operated, and knowing for a fact that the exact same psychological traps are being used against us right now, can you spot the Ponzi's hiding in your own social media feeds today? Take a closer look, ask the hard questions, and protect your wealth. Thanks so much for joining me on this deep dive into financial history. Keep learning, stay vigilant, and I'll catch you in the next one.